Welcome to Finance Decoded, your one-stop financial education channel. Today's topic, the loan-to-value ratio. In this video, you will learn what is the loan-to-value ratio, also known as LTV ratio, how is LTV calculated, why is LTV important, how the type of mortgage and house price changes can impact LTV, and finally, how can you decrease your LTV? As always, timestamps are in the description box below. What is the loan-to-value ratio? The price you pay to purchase a property consists of your deposit and your mortgage. The LTV ratio looks at the amount you borrowed, so your mortgage, relative to the value of the property. So how is the LTV ratio calculated? Firstly, take your mortgage and divide it by the property value. Then, multiply by 100, as the LTV is generally expressed as a percentage. Note, the property price is really the amount your bank or building society values the property. Why is LTV important? Well, lenders, i.e. your bank or building society, use it to determine interest rates. So what is an interest rate? It's the cost the bank or building society charges you for borrowing money from them. So you pay back the amount you borrowed plus the interest. The rate will increase if your lender thinks there is a greater risk they may not get back the money they lent you. The higher the LTV, the more money at risk, and the easier it is to fall into negative equity if property prices fall. Meaning if the property is sold, the bank would still be owed money. Remember, if your LTV is too high, e.g. over 95%, you may not be able to get a mortgage with some banks or building societies. In today's climate, many lenders are asking for a minimum 15% deposit and so 85% LTV. Let's look at an example. We want to buy a property for £250,000 and fix the interest rate for the mortgage for 2 years. As you can see from the table, the higher the LTV, the higher the interest rate, and the more you pay. So, how can mortgage type and house price changes impact the loan-to-value? Well, let's look at what happens when you've owned a property for several years and have an interest-only mortgage or a repayment mortgage. And we'll see what happens to the LTV if the property value stays the same, increases, or decreases. Let's continue to use the previous example where we buy a house for $250,000 with a mortgage of $225,000, so a 90% LTV. If the house price stays the same, with an interest-only mortgage, the LTV will not change as you have not paid off any of the money you borrowed. With a repayment mortgage, the LTV will decrease as you are not only paying off the mortgage, but also the capital. So the mortgage has reduced from $225,000 to $205,000. When house prices increase, LTV will decrease on both interest-only and repayment mortgages, but there will be a larger decrease on the repayment mortgages, due to the capital being paid off. If house prices decrease, the LTV will go up on both mortgage types. But with an interest-only mortgage, there is an increased likelihood of falling into negative equity. This shows how risky interest-only mortgages can be in periods like a recession, where property prices tend to fall. These calculations also show the risk of having a higher LTV. If the initial purchase was with an 80% LTV, and so a mortgage of £200,000, we wouldn't be in negative equity even with an interest-only mortgage. How can you reduce your loan-to-value? Firstly, you can increase your deposit when you buy. Secondly, you can get a repayment mortgage so that you pay off the capital and by the end of your mortgage term, you will own 100% of the property. Thirdly, you can overpay on your monthly mortgage payments. Subscribe and click the notification bell below to be notified when the video explaining this premieres. And lastly, you can add value to your home through renovations, such as a loft extension, a lick of paint, or a new kitchen and bathroom. So that's LTV explained. Thanks for watching Finance Decoded. If you enjoyed, then give the video a like. Want more? Subscribe below. Thoughts? Comment below and leave suggestions of videos you want to see next. See you in the next video.